Hello, I'm Mitch Goldberg. Welcome to another live episode of Be the Boss of Your Money. This is the place where you go to learn all about personal finance. This is for all skill levels from beginner to advanced, young and retirees. This is about personal finance, investing strategy. It's about your credit score. It's about what you should do, how you should react to different market conditions. And we dissect the latest, most important financial news so that you can get a handle on things to make sure you are invested appropriately for your situation. We're going to get rolling right now. Rates up, hot stocks down. That's the story of the day. And I think that's going to be the story for a long time to come. We're going to roll a quick intro. We've got a couple of things to cover and we're going to fly through this. So here we go. Whoa. Pardon me. That never happens. Water. Wrong pipe. Whoa. Sorry about that. Here I am, like dying on my own live stream. Excuse me. This is live, and just a lesson: never take a sip of water right before you're about to go live, because this is what can happen. So let's get into the day's action. Look, there's a few things to unfold here, a few things to unwrap. The big thing to me is sorry, guys. The big thing to me is this. What good is a portfolio, an investment strategy, if you can't stick with it? People are always rather brave. They have their bull market beer muscles going. When their account is up and stocks are up, they go, yeah, I can take risk. I can invest. I can invest aggressively, and I can own the SPACs, and I can own the work from home, stay at home stocks, and that whole cohort. We talk about this like every day now for a year, right? And when the stuff hits the fan, sometimes some people get scared. Now, I know you're in it for the long term. That's what we preach here, long-term investing. But as far as the long-term thing goes, I think long-term investing still needs a level of diversification. And when I say diversification, I don't mean having the ARKK fund and the triple Qs, the QQQs for the NASDAQ 100, and then maybe own XLK, the ETF, for the big ETF that represents the tech sector in the S&P, okay? Now, diversification, it's a strategy that is not meant for maximizing returns. It's a strategy meant to minimize risk so that your worst performing investment doesn't become your whole return, or it doesn't have an outsized negative effect on your potential returns. And I think just the fact that the S&P 500 is like 30% in its top 6 or 7 stocks, and they're all, tech or tech related, work from home, stay at home related, and ARK, the triple Qs. I don't think there is the diversification there that I'm really talking about. I want to share with you a little lesson from the year 2000, because back then we had the Munder Net Fund. And if you've been around a long time, you may remember that. It was the hottest thing going. I mean, they had these great commercials. Whoever thought we would be, going to the supermarket, we would be waiting, we would be shopping online instead of waiting in line. And then they show a bunch of people waiting impatiently on this long line at the supermarket. But that was the hottest thing going. And the fund went from like 5 or 6 to like 115 in maybe a year and a half, 2 years. And they could do no wrong. And all of the hot stocks of the day were justified because it's a new paradigm. It's a new business model. If you're knocking it, it's because you don't understand it. And every time it went down, and there was the Van Kampen Select Technology Fund, the Monument Fund, and a couple, the Janus 20 Fund, and a couple of other really hot names and very popular analysts and fund managers on TV defending this stuff like crazy. And they would speak with such confidence, like they really understood the new paradigm. And anyone that would say overvalued, up too much, it doesn't make economic sense. The defenders, these famous analysts and fund managers, would be like, yeah, that's from people who are old school. They don't understand the new paradigm. I pity them. Let's feel bad for them, but they're really out of it. We need to, just forget what they say and just go with what we're doing. And it was all about Sun Microsystems and Oracle. I know like Oracle and, Yahoo seem like old tech names to you now, but back then they weren't. Yahoo, AOL, these were like, hot, new paradigm names. Amazon was also, Yahoo was bigger than Amazon. I mean, Yahoo was like the beast. That was the leader. Qualcomm. And, when the bubble finally burst, people kept buying these stocks, going back to the well. They would rally. They would have a rebound for a couple of weeks. People would get excited. And then the famous analysts and fund managers would say, you see, I told you, everything's fine. We're going to have dips, but we're in it for the long term. But the long-term investors did so badly that no matter how much time a lot of them had, these stocks wouldn't ever recover. I mean, who buys Yahoo? Is Yahoo even traded? I think Yahoo was bought by Verizon a long time ago, and they'll probably write that off as like a losing or non-performing asset. Sun Microsystems was a hot stock. It went down to 5, and then finally was taken over by Oracle for peanuts. Lucent was $100 a share. It went down to $1. I mean, Lucent was one of the most widely held stocks in America. WorldCom was one of the most widely held stocks. Enron was a widely held stock. Some of these stocks went down because of fraud, but a lot of them went down just because their economics just no longer made sense and they were so crazy overvalued. And it took the NASDAQ composite 15 years to get back to its year 2000 high. Can you imagine waiting 15 years for an index to get back to a high? But if you were diversified and you had, other sectors, you would have been okay, is what I'm saying. So you take a look at the high flyers today. Maybe they'll keep going on. Maybe Cathie Wood will continue to outperform and put up these incredible returns for the next 10 or 15 years consistently. The odds of that happening based on, throughout history of the mutual fund industry, I'd say the odds are 0. I'm just going, by past performance, which is no guarantee of future performance. But every hot fund manager with a hot hand eventually underperforms the market. Okay. And this is why I'm so into this stock diversification. I don't think people are really, a lot of you are, I don't think are getting what I'm saying, or maybe now you're getting it with diversification. So that is the first thing. The battle right now, and what we've been going through for from the March low until about a month ago was a battle between work from home, stay at home stocks versus the economy reopening stocks, this economically sensitive stocks. Okay. So you have the economically sensitive stocks, and I'm talking industrials, energy, financials, materials. These are the economy reopening stocks. But now it's not just the work from home, stay at home stocks against economically sensitive, reopening stocks. Some people call it the rotation. Now the work from home, stay at home stocks are fighting interest rates also. So now it's like a 2-on-1 battle here. And we had a big interest rate pop over the last 2 weeks. The work from home, stay at home and hot stocks, SPACs, they tanked. It was a rough time. And especially for individual stockholders of the hottest stocks got hit the hardest. Monday, interest rates backed off a little bit. I think basically because the 10-year treasury, even though it's about like 1.45%, it's still a lot higher than the German Bund, the Japanese 10-year, or the British 10-year. Okay. So it does make our 10-year treasury attractive for foreign buyers, global investors, but it's not enough to fight what we see as this tidal wave of economic strength and how strong the reopening story is. Like what I thought we were going to get in the second half of 2021, it's arriving a lot earlier. And stats I see, for the most part, and these are all major stats, are pointing to a lot of economic strength. So anyway, this is a battle. Every time interest rates go up, and investors worry about that, your hot tech stocks, your work from home, stay at home stocks are going to sell off. And it's just a seesaw. That's how it is. If interest rates don't go down, which would reflect a continued slow economy where you get that old expression, bad news, bad economic news is good news for the stock market because interest rates stay low, the Fed remains accommodative, we get more stimulus. When that goes away, it gets back to the reopening sector and the work from stay home sells off. And that's just the battle. And I think that's where we're going to be for a long time. Okay. So not beating the dead horse with a stick here, but that's what I see happening. So I had a LinkedIn post a couple of days ago on Monday, and I'll look for it while I'm talking to you. By the way, folks, if you're watching this in the live stream, you're right now, welcome. If you have any questions, let me know in the comments. Personal finance, investing, that's what the comments are for. If you have a question, hit me up. Words of encouragement, words of wisdom, share your experiences. Those are all welcome. Also, if you're watching in the replay, certainly ask me your questions as well. I'll see the notifications. So I'm just perusing my my LinkedIn profile while I'm talking to you. I post on, by the way, if we're not connected on LinkedIn, connect with me there. That is where I post the most content. It's overwhelmingly educational. And I would say most of my content is actually commenting and sharing wisdom on other people's posts. So you definitely want to follow me, connect with me on LinkedIn. That's the place that I go to. Okay. So, but anyway, the post, if I could pull this up, it was a couple of days ago. So it takes a little while to find it because I post a couple of times a day. I know I post a lot, but that's my business. That's what I do. And in a day and age when there's no in-person networking, my live stream and my social media is my networking. So instead of spending time going out to the Hilton Hotel or someplace and eating the cheap pigs in a blanket and having a watered down drink, I would much rather do this than sit on my hands and wait for the economy to reopen. So I'm very proactive like that. I prefer to do something. You've got to do something. I'm so glad I started live streaming, by the way, before the pandemic. Okay. So these are some of the things that we're talking about. So the Post anyway said that if you were worried about your stocks going down last week and you're in the high flyers, you're in the Teslas, the DoorDashes, and these are great companies. These are economic miracles. I'm not knocking them, but we're talking about stocks, which is a different ballgame. Okay. So we're talking about stocks. It's a little different. Because if they're high flyers, so they have a lot to do with interest rates. They have a lot to do with Federal Reserve policy, monetary policy, tax policy, et cetera. So if I'm just going to give up on finding that LinkedIn post. I'm already telling you about it anyway. But Monday, if you were worried about your stocks, I'm not talking like if you're, a 401k investor and you're diversified between the major asset classes. But I'm talking if you got too heavy into individual stocks, if you're a financial advisor working for your clients, or if you are an individual investor and you're worried, Monday was like a second chance to recalibrate, to review, and look at your portfolio, make sure you know what you have, maybe scale some winners back, move the money into something more stable. Maybe you're too heavy into stocks, not enough into cash and fixed income. Whatever your personal asset allocation should be, take advantage of it. Don't go back to the thought process, oh, everything's fine. I'll take a look at things later where the market's back up. Because that is just complacency. And I've seen more investors lose money because of complacency than anything else. That's my own experience, the value of my experience that I want to share with you. Okay, so that's one thing. Another thing I want to talk to you about is this, the stimulus checks. Did you groan? Did you just like scream when you heard about the cutback in the stimulus checks? They're still for $1,400 for people making under $75,000, couples under $150,000, head of household under $125,000. Now, if you're an individual making $75,000, the stimulus check gets reduced a little bit for every $1,000. The stimulus check would have gotten reduced a little bit for every $1,000 you make, up to $100,000, where you wouldn't get any stimulus check. But instead of making that $100,000 range, it's more like going to be $80,000. And instead of $150,000 joint income, if you file jointly, it's phased out by $160,000 instead of $200,000. So if you were making like $160,000, $170,000, or $180,000, and you're like, I'm still getting a check, that's cool. No, it phases out at $160,000. So it's a very steep phase out. And Biden says he's cool with it. So that's I'm personally pretty much assured, super confident that that's what's going to happen. It knocks out probably about 40% of all the people who would have gotten a check. It's a big deal. And people, a lot of people in Congress feel, well, if you make $180,000, you shouldn't get the check. It kind of punishes a couple of states where incomes are higher. Incomes are higher in certain states like New York because the cost of living is higher. I'm not talking about the entire state of New York, by the way. Upstate New York, it's like a different state. It's totally different. But that's who it hurts. All the states that got hurt by losing the SALT deduction are the same states that'll get hit or hurt with this reduction in the cap. So something to think about. It's pretty disappointing to a lot of people, and it knocks out people who are taking care of adult age special needs children. It knocks out a lot of people who are now caring for senior citizen parents. And so when you think about it that way, I think it does more harm than good. That's my opinion, but that's the latest on the stimulus checks. Okay, so what else do we have here? I have my notes here. So we talked about a couple of things. So I just want to show you a couple of things in the screen share, okay? Okay, I'm back in the corner here. This is the the winning sectors of the day: energy, financials, industrials. Now, you're a viewer of the show. How many times have you heard me say you want to see the economically sensitive stocks work out, lead the way? That is exactly what happened today. So interest rates went up a little, hurts the work from home, stay at home, hot stocks, the high flyers. But it doesn't really hurt so much, in some cases, not at all, the economically sensitive stocks. I always say energy, financials, and industrials are these sectors that you want to see lead the way. So in spite of it being a pretty bad day, all the major averages were down, okay, you still have those three sectors that we always talk about were up today, very modestly. Energy was up nice, up almost 1.5%. Financials up almost 1%. Industrials up a smidge. But that's a good sign that the reflation trade, the economically sensitive trade, is intact. And so it's two things: reflation and interest rates versus work from home, stay at home stocks. I'll show you something else. Take a look at the industrials. GE just has been a beast, right? Up another 3.5% today. American Airlines, Wabash, UAL, Boeing, Cummins Engines, Korn Ferry, Eaton Corp, Oshkosh, Emerson, Johnson Controls, okay, 3M, United Rentals, Honeywell. A couple of were off a little bit, but overall, industrials had a pretty good day. And let me make this a little bit bigger so you could see it on your little smartphone there, okay? The Dow off 121. It was up most of the day, just skidded at the very end of the day, but barely off. NASDAQ off a good amount, almost 3%. S&P off a good amount, over 1.5%. Gold off a little bit. The VIX was up today, so people are getting a little bit worried. But let's take a look at the FANG names. Just to give you an example, Facebook down, Apple down, Google down. Google's down a lot. Microsoft, Amazon, Netflix. I think there's a line in the sand here with Amazon. Amazon breaks below 3,000. That would make me worry about a sell-off spreading to the rest of the sector that it's in. You know, work from home, stay at home. Okay, that would worry me because that has been for Amazon the price to hold is $3,000, and we are perilously close to hitting that range. So you just take a look at that, and that is something that I think we've got to keep an eye on. Okay, what else? Did we miss anything? No, I think we've got everything. So I really appreciate you taking the time to watch us on Be the Boss of Your Money. If you have any questions, you'll let me know. If you didn't think of anything, but you think of it later, hit me up in the comments, send me a DM. Ron is out there with an audio tip, voice actor's tip. Before going live, put a few drops of extra virgin olive oil on your fingertip and rub all over your teeth. It helps prevent mouth clicks, like smacks like this, like that. And you're talking it up. Do that in the middle of a conversation, in the middle of a sentence. Smacks and dry mouth, and also reduces sibilance brought on by the dry heat in the studio. And I have a lot of lights on me right now, so that is a great tip. Thank you very much, Ron. Who else is out there today? Ron, Steve, I'm so glad you could join me, and Judy, and I see a few other people watching, but if you don't give it a like or a love, some reaction, I can't see your name. But I'm going to get going. This is a little bit longer than I expected, and I'll be back tomorrow at our regularly scheduled time of 4:30. Thank you.